All right, stock market. What is going to happen for 2022? The crash of all times is going to no. I'm not going to try to sell the FUD. Everyone sold the FUD, fear, uncertainty, and doubt, back in 2021. But I counseled somebody at the beginning of the year 2021 who their religious leader told them that Trump was going to stay in office and the stock market was going to crash. I at least talked them out of selling all their retirement assets. But basically, they had to find out for themselves that Biden was going to be president. So I can't do anything about that. You can't fix that. 2022, I go into it the same way I go into 2021. Let's look at the statistics. All we can know is what came before, and usually it works. So I brought this up, posted it earlier this week. Basically, we had a big 2021, 20% gains. And what does that mean? Well, this article talks about, it crunches the numbers and it tells us that when you have something like this, the annual performance following a 20% gain, this is the chart. So, you have, of course, you have up years, more up years, the down years, and you, of course, have your outliers. But let's find the key thing right here. History suggests that after a gain of at least 20%, by the benchmark, returns are comparably muted but not insignificant, with an average rise of 7.7%. The year after a big rally also tends to be followed by a positive finish for the index in the subsequent calendar year of 70% of the time. Gains have occurred consistently the previous 9 times that the S&P 500 has posted a 20% rise or better. Okay, so we got a 70% shot that the S&P 500 is going to close whatever the last day of the month is. I haven't looked on 2022, higher than it is today. That's all we're going to say. And that's going to be close to 7.7%. One of the big things I talked about in the beginning of 2021 was what it meant to have a president elected with a unified Congress, both houses unified, same party. 2017, this was following the election of Trump here. Where's November? Yeah, November 2017 was an up and to the right year. We're going to get back to this little price action right here in a minute. But that was what happened after the election. Same thing. President elected, unified Congress. Why that's the case, I don't care. That's the statistics. Okay. And so what it basically says is the year after election, the average was 6.5%. The second year, 7%. That's what we're in. Second year after the election. Third year, that's an interesting number. That's a 2023 prediction. We'll see how that happens at the end of the year. Since 1950, the average annual rate of return, this is important. The average annual rate of return was 7.8% adjusted for inflation. Okay, hold that number you have, 7.68%. Let's call it 7.5%. The prediction for the presidential model is we'll have a 7% year. Between 1950 and 2019, this data is a little bit old, the stock market experienced gains 73% of calendar years. Go back to the prediction here. The year after a big rally also tends to be followed by a positive finish for the index 70% of the time. History suggests after 20%, the average rise 7.7%. They're all the same. It's just another year. That's my prediction. That's my big, bold title. Warning, it's going to be an average year. But that's what the statistics suggest. There's nothing else I can really say with confidence. I'm going to operate under the pretense that we're going to have a different year than 2021. And now here we go into my opinion. And this is based on my experience. You had a stellar 2017 up and to the right. Yeah, you had some little dips of 5% in there that got everybody nervous just because they were outside the norm. But man, 2018, that's another story. That's where you got your comeuppance. This right here, let's mark it off. This was January of 2018. Rose, that's a parabolic right here, followed by a taper tandem because the Fed was tapering. That's what everybody's scared about right now. That's what everybody is so fearful about in the stock market, is the last time the Fed tried to raise rates and taper its bond buying, the market threw a fit, a taper tantrum. Everyone always thinks that the next crash is going to be like the last one. That's why people, since COVID, were trying to scoop up cheap houses, hoping they would get another opportunity like 2008. They thought that we were going to get another housing crash. Instead, the opposite happened. The assumption that as the Fed is raising rates, that that inflation is going to be the catalyst. I think because everyone is assuming it, it makes it almost the least likely vector that that's going to happen. Maybe it is, but crashes they come out of left field. That's the nature. No one's prepared for them. No one's got protection. No one's buying puts. No one's hedging. They're all long this one thing, and something out of the ordinary no one expected, except maybe a few people that get to brag about it after the fact, they get burned. Let's go down to the daily here, because I want to talk about 2018. We went through the statistics. My opinion on the upcoming year, as a first principle, it's not going to be 2021. It's not going to be up and to the right. That's my opinion. You just don't typically get 2 years in a row of that kind of action. I mean, there was 2013 and 2014, and this is where I started my career. I didn't realize at the time how crazy of a year this was. But then after 2013, you had this October crash, a 10% event happening in October. And then that really dented a lot of the momentum, a little dented a lot of the confidence. People get lulled into a false sense of security in a nice little slow bullish trend like this. Volatility starts to kind of dry up. Everyone assumes that the gains are going to go on forever. And then they get a wake-up call, and that dents a lot of the momentum. And then that sets up for a really this was a problem. I got burned in the 2015, which was another minus 10% right there. And then after this little brief hiatus, we go on to the next cycle. And then again, you have that up and to the right, lulling people into a sense of confidence. You have a big parabolic move. This is awesome. Everything's going to go on forever. And then you have that denting of momentum, which then sets up for a very hard year to be long. Now, that being said, I had the conversation with somebody earlier this week about what the 2018 market meant for me. This was when I was still trading a lot of options. It was an option buyer's dream in 2018. You had this dip right here, which again, remember, with Ichimoku, this is the daily, long term. You can see this coming on your weekend homework. Momentum got below the cloud at the same time as price. You even had a pullback within these few days right here, which sets you up. That's when you can start buying puts, okay? All these people that want to buy SPY puts when the market takes like a little 1% dip off the high and they just lose money, they'd be better off just buying SPY shares. I wish they would do that instead. This kind of market, if you have something like this, is where you start to buy puts. Volatility expands. That means the prices of your options just generally get lifted in addition to the delta that you're getting off the puts. I'll just admit to you, this hurt. I spent the whole year getting back, and I did not get back to break even on my portfolio until October. And then I was in good shape for that year. And then, well, I got another Christmas present in this downward cycle right here. Look at this. This is the market where you buy puts. If you want to be contrarian, if you want to be a bear of the stock market, this is what you need to look for. It only happens every few years. I'm not saying it's going to happen necessarily in 2022, but this kind of market, a trader's market, can happen after a big up and to the right year like we had. Every year is going to be different. That's why I love trading. That's why I love it. Every day is different. Every day is a new challenge. So you can't assume that what worked in 2021 is necessarily going to work in 2022. You have to be looking for opportunity. You have to be reading what the market is telling you. We're still bullish. There's no reason to short the market right now.